All right. Well, thank you everyone for joining us today. This is our 7th episode of our webcast series, Affluence to Wealth. My name is Sarmen. Here I've got Ara. How's it going?
Good. How are you?
Yeah, not bad, not bad. I can't believe it's episode 7.
I know. It's crazy. So I can't believe it's been a year since you've joined. Almost a year.
Almost a year, exactly. And so this is our 7th episode. And do you remember I think a few people have said 5 episodes is kind of the limit of the make or break it, because you start running out of guests, start running out of ideas, and
or you give up.
Or you give up, exactly. So this is our 7th episode, and you guys are making it very easy for us. We've had a lot of interest and questions from both investors and business owners to learn more about this no tax minority exit. So that is the topic for today. And we're also going to give you an update about some of the deals we've passed on in the pipeline and are upcoming. So thank you for being here. If you've got any questions, feel free to put them in the chat and we'll definitely address them. All right, let's share our screen. Great. We got a little ahead of ourselves. Great. Okay. So
the situation. So we constantly ask, what kind of companies do we target? And again, our strategy hasn't changed. We like owners that are mature, that are looking for retirement. They've built a good business. Doesn't have to be a massive business, and they're trying to plan their retirement. So that's still our strategic target for the situation, and it works very well for us because we could add value to those situations.
Yeah, generally baby boomers, people looking to retire or partially retire in this case because they want to still work and keep some control. EBITDA generally in the range of 1 to 3 million, and stake.
Yeah, well, the EBITDA, the 1 to 3 is for minority.
Yeah.
So we go under 1 million if we're going to take majority. So those are our two strategies. And the stake, yeah, it could be anywhere from 10 to 30%. We kind of work around our sweet spot in terms of dollar investment. So that's around 1 million.
Yeah, and it's really a blue ocean strategy, because we're finding not many professional institutional investors playing in the 1 to 3 million EBITDA space because they've got a fund of, let's say, over $100 million. They're not going to look at a deal of $8 million.
Yeah, it's hard work. It's just almost just as much work to do a smaller deal than a larger deal. But we see the upside a lot more on the smaller deals.
Yes, and stage-wise, established businesses, good reputation, industry or sector. We say agnostic, but really we are very picky, and we do prefer industrial manufacturing and industries of those like.
And our main question is always, would we personally invest in that business? And the other one is, would a larger investor in private equity be interested in this for us as an exit if it was better managed or if it was larger? So that's our actually litmus test.
Yeah. And exit wise, if a private equity fund's going to buy it. Exactly. Okay, great. So this is an example you wanted to walk us through it.
Yeah. So let's suppose a company has an EBITDA of 2 million, and we generally like to pay 2 to 5 times EBITDA. So we're going to use 5 just to make it easy. That puts the valuation, enterprise value, at 10 million, assuming there's no debt. So the business is valued at 10 million. We want to purchase 10%. That's $1 million consideration. Now the cost could be 0 or whatever it was for them. Let's assume it's 100,000 for the business owner. So that's 10,000 cost. So you would normally have a capital gain of 990,000, and which will be taxable probably at 25%. In our case, if you use the lifetime capital gains exemption, it'll be minimal tax. It might cost you 10,000 or a bit more. But just to that point, though,
right?
You're cashing out 990,000 or $1 million in this case. If you're going to take income of the same amount for whatever reason, you want to buy a cottage or give it to your kids, whatever, you're going to pay at the top tax bracket. Right. So you're going to have the company has to earn, say, 2 million in order for you to get $1 million out. So it's a significant difference. using this structure, assuming you qualify, which we'll get through that.
Yeah, we'll get through.
Yeah, most businesses should.
So we wanted to walk you through the benefits of not only the business owner, but also the business if you sell minority stake to specifically us. It is certainly de-risking for the business owner because, of course, when you own 100%, you're exposed to 100% of any risks. And if you sell 15, 20%, then of course, you're de-risking a little and you're taking cash out. So reducing that financial risk.
Yeah, and also we try to remove personal guarantees when we get involved in businesses, and we've been successful at doing that. So that's part of the de-risking. The tax we talked about already, and
yeah, control. We're talking with a few business owners, some that just want to sell 100%, and that's fine. They want to move on. They want to ski in Whistler or whatnot, as they rightfully deserve that after working so hard. But a few business owners want to still work, but take some money off the table and take some risk off the table. And so the benefit is when you're a majority shareholder and you only sell, let's say, 20%, you still have control over the business. But we still do like to get involved.
Yeah, and also I think one of our participants, actually, it's a family-owned business. They want to maintain that legacy. They don't want that to change necessarily. They want to, have their family part of the ownership. So that's where we come in.
Definitely. And then succession, this is key, right?
Yeah, exactly. So you need to plan in advance, but this does allow you to start the planning because, you start putting agreements in place, and this gives you an opportunity to let employees participate. Actually, we're involved in a business now for that reason. So they want employees to be involved in ownership,
right,
and for them to stay longer.
And to be honest, that's a very important factor for us. We have a scoring matrix of 10 factors that help us score a business. One of them is succession, and if all the trade secrets and all the success of the business is in one business owner's head, then it's hard for us to take over. So it's key that they train people, which I think would certainly help market the business for future sale.
Yeah, and we always ask, if we can add value to it, there's no interest in us in investing. And the value add we would generally bring to minority is the governance aspect. So you would need new shareholders agreements, would probably push the founder up to a board level where they reduce their role. Another easy win is marketing. We have partners who are marketing experts, and especially for small business, it's so easy to add.
But what's interesting is people like small business owners, let's say they manufacture glass. They'd think their online presence is not important. But like we said in the past, how are you going to find the future generation? If they Google your business and it's not even found on Google, that impacts younger generation's perception of working somewhere. So they want to feel proud. They want to see that they've got an Instagram account, LinkedIn account, they're active, and sure, they manufacture glass, but you still, in today's age, you need to certainly stay active online.
Exactly. And strategy is a key part of it. We help set a strategy, and part of it is putting in systems.
Right.
And that's where the finance comes in as well. One thing that's good is that a lot of these companies already have a decent accounting system, but then they may not have a project management system or other developed systems.
Yeah, because they're focused on it starts from a 2-person business and then it goes to 20. They don't have dedicated finance people. So the last point we'd say is liquidity, and this comes in 2 factors. One is if a business has fully maxed out their line of credit, we have in the past been able to quickly finance certain jobs so that they can bid on certain jobs. And we do that quite fast. So we found that to be quite beneficial for business owners where we partner with them. The second form of liquidity is, if they want to sell shares in the future, the business owner, they could use our platform, and if we've, let's say, for example, purchased 20%, then there's those shareholders that I'm sure in today's portfolios that we have would love to purchase more shares. So liquidity of our platform, which we just created, and this is a little video there to show the process. You enter your sale price, agree to the terms, sell my shares. And then this is another user. Any user on the platform goes in, they would enter their bid, and if that bid is the highest, then it'll tell you it's the highest, and then you have a certain time frame. So
yeah. So to clarify, so we're exempt market dealers, and what we do is we seek and we vet investment opportunities, and we manage the due diligence process, and we post it in the platform, and that's where you see the user. And our agreements allow you to sell your shares, so you're not stuck with that investment. And that's where the secondary market comes in. When you post the shares for sale, it has to go to the existing shareholders first, and they have a first right of refusal. And if they don't act, then it goes to our wider investor base, who are accredited investors. So it's very private. I know a lot of business owners don't want to divulge information, and that's how we work as well.
right.
We, even when we post a deal, we don't we don't share the name of the company, partly because it's extremely confidential. There's financial information in there, and also we don't want anyone to circumvent us as well.
Right.
So
Exactly.
lifetime capital gains exemption. So we covered this in episode 3. We had a special guest, John Isla from Siegel, who was our auditor, to cover this. So I don't want to go through this in detail, but please watch that episode. But in general, most businesses, small businesses, should qualify. However, the message is you got to plan now in advance, right? So if you're ready for our investment, you may not be ready to use the exemption. And there is a 2-year hold period for our investors. So we try to structure our investments so that you do use the lifetime capital gains exemption. And it doesn't always work out, but that's our goal. But yeah, seek advice on this, but it's a major tax saving for
It is. And the way we've structured it, we've spent a lot of time and money to structure the holdco, the company that you're investing into, so that you can take advantage of this lifetime capital gains exemption. All right, so we'll pause there before jumping into deals to see if there's any questions. Okay, we've got one here. So someone's asking, how many portfolio companies can we manage, and what's our scaling? What's our scaling model?
So great question. Every deal we get involved in, there has to be a deal lead from our end. So it could either be us or one of our partners. So we do have investors who are flexible, who have who are, I guess, semi-retired, but still want to manage a portfolio. And what we try to do is have a portfolio lead that is either has a relationship with that portfolio and potentially has brought us that portfolio, or has expertise in that sector. So that's our scaling model. We'll be tapped out soon with our deals, and we're working with our partners to actually lead those portfolios.
Yeah. And the other question is, can you talk a little bit more about how you value the time that you're putting into the portfolio companies?
So we generally don't get involved in operations day to day. That's not our goal. So we work through the board as an active board member, and we do charge for that. But it's not significant. It's generally anywhere between 50 to 100,000 a year, and we share that with whoever's actually doing the work. But it's active work. It's not just a board role. It's leading the value add verticals that we mentioned. If it's governance, marketing, finance,
and we do. We have 11 interns. They're all great, different universities from across Canada. And they certainly help us with a lot of the LinkedIn posts, and there's a lot of work that happens behind the scenes, beyond the strategy as well.
Exactly. I think a lot of our work is reviewing deals and turning them down. That seems to take a lot of our time.
Yeah. Well, there's so many deals, and it's a lot of work, but it's diamond in the rough, right? So okay, so we've got another question here. You said established businesses. Can companies under 5 year old but with high growth and 1 million in EBITDA do this?
Yes, you can. So we're
This was going back to our we look at established businesses, mature businesses. So I guess, criteria of 5 years, 1 million EBITDA.
oh, for sure. So
Yeah.
we want EBITDA is the key. So absolutely, we just don't invest in startups. That's the point we're trying to make. And our marketing is focused towards retirement, but no, absolutely. Reach out if you have one of those businesses.
Well, we do find, like this is a different topic, but we do find, deal source is a very big topic, and there's multiple ways you can find a deal. Certainly, one way that we love is through word of mouth. We find that's the best. Okay, great. So let's jump back into our deals portion.
If you have any more questions, just send them across.
Yeah. Great. All right.
So that's our scoring matrix that on the right that Sarmen mentioned. So you could see the high weighting on low entry valuation. That's because we know we add value to it, but it's a fair. So we take a fair approach.
Yeah, the thing is, when you're scoring a business, it's not black and white; it's subjective. But we certainly approach it in as objective as a manner as possible through this scoring matrix, and we actually score independently and then discuss it. So we do have that, and lift one.
Yeah, so this is like unfortunate because we had raised the funds necessary, strong interest from our investor group. We had a bank lined up with no guarantees, no personal guarantees or corporate fee. So the deal was almost done, but we actually we pulled the plug on it. Well, we actually came back with a revised offer because what we found, and interest rates is one of the reasons, is that the company may have required more working capital than we thought it needed. It's always been banked by the owner, and they had a few million in the bank at all times. So we tried to renegotiate with them having a vendor loan, but it wasn't accepted, unfortunately. So we're extremely cautious.
It's sad to see, because you've been chasing this deal for over a year.
Yeah.
We are deep into due diligence, but
Yeah,
at the end of the
close.
day, I think being strict and being disciplined is very important in these deals, because you don't want to end up with a headache. So we do have another question here. What would your highest equity investment be in dollars?
Okay, good question. We don't know is the answer. So right now our target is say 1 to 2 million. However, we do have people approaching us saying and asking us for larger deals, and they would co-invest. So we are actually, it's on this list at the end, but I'll cover it now. There is a $5 million deal that is extremely interesting. It's a convertible debt deal that we've already had feelers from some of our larger investors, and they would be interested. So
It really depends, right?
Yeah.
With of some of the deals, like the deal that we're currently in DD, we have seen a lot of interest, oversubscribed. So I think it depends deal by deal, but yeah, you could say 1 to 5 maybe.
Yeah, and then if it's opportunistic as well.
Yeah.
So we're more into, is this an opportunistic deal? And if it's larger than even 5, then we feel we could find the investors for it. So
and just to mention, we also co-invest. So it's not just trying to raise the capital from other people. We also do co-invest. Great. So lift 2.
So lift 2 is partly because a lot of our investors were going to invest in lift 2. There's synergies between the two, and that's why we declined lift 2.
Heat 1. This is interesting.
So this is a portfolio company, and we're not into buying property. That's not our main business goal. However, when we met the business owner for Heat 1 early on, that was one of his concerns, is that we're going to be priced out of the property. It's in an area where property prices haven't creeped up like they have in Western Ontario. And we came across a really opportunistic property, which we're probably gonna fund through dividends of the company. So He1's doing really well. And He2 closed. That one we didn't make public. Sorry about that, because He1 investors had first right of refusal, and it was taken quite quickly. So we didn't post on our platform.
Yeah, I'm actually gonna go off that list. I just realized we have one Project Divide that was not on the list, and the talk about real estate actually made me realize or remember this deal. We were doing due diligence on a deal, and it turns out that this business, which is profitable, has their lease coming up in February of 2024. And when they re-sign the lease, it will be 3 times more expensive than what they're paying now. So, and we saw this with another deal as well, that sometimes if they own the real estate, what they're recording as the rental is not really market rate, and that's what's really allowing them to make profits. But if you adjust to market rent, it just erodes a lot of the profit.
And the issue is a lot of those businesses. There's one deal we saw that's not on the list either. Very interesting, but the property's worth more than the business.
Yeah, exactly.
And so it became too large of a deal for us.
Yeah. We love the pet industry. The pandemic pet boom has certainly taken off, and actually Bloomberg recently released an article saying the industry continues to grow. So we're very bullish on the pet industry. This is Project Fur. We're currently in due diligence. Things are going well. We're moving forward, and we're very excited on this deal. We are fully subscribed on that deal.
But there's always, I would say, you never know if anyone drops off. So
right. We do have people on the waiting list hoping that there could be a drop off.
Yeah,
certainly. This is Project Purr. It's again in the pet industry, and it's in preliminary stage. It's a very small deal, but given we're looking at potentially a roll-up strategy in the pet industry, then we're happy to look at smaller deals as well. So deals update. Project Wall, this was a deal that we signed an LOI. We're deep into due diligence. Unfortunately, we had to pause it due to some factors that came up, but hopefully we can revisit it. We really like the business owners and the product that they provide.
This is I can't say too much about this one, but there's a draft LOI that we're working on. Very interesting. It's a professional services firm. It's small. It's really supporting a management buyout, which is also very interesting. So we're going to support an employee to buy out the remaining majority shares.
Yes, we'll leave it at that. Golf One.
So this is again one of our partners that we work with that has the relationship. Very interesting business, and this is exactly one of the reasons we're doing this webcast. It is a minority exit, successful business, and they're planning their succession and in a good way. So we really like this. But we're in discussions right now. And again, same sector, completely different business. It's more services. Again, there'd be potential synergies, but that's not, actually, there probably won't be synergies between the two, but it's the same sector. Again, we're in discussions. Can't divulge too much there.
Right. Okay.
Another question.
Great. We'll move on to the next one.
Okay. Should we go after the question, or?
I probably not.
Okay. So
convert. You talked about this.
Yeah, we talked about that. Yeah.
Okay, so we'll leave it at that. We do have a lot of deals. We just wanted to leave some time for questions if there are any further questions.
Yeah, this one. Let's take this one. So interest in 45 million roll up across Canada. Not at this point. So we're very strict with. So the question was, would you have interest in a large deal, $45 million roll up across Canada? Maybe, but that's not our focus right now. So, but get in touch with us. But that's probably in the past.
Yeah. It's interesting. I remember just minority exit is so unique, and when we talk to business owners who want to sell 100%, when we tell them what we do, they're like, "Damn, I wish I knew this before," because it's still allows them to work. They don't retire. They take some money out, tax free, up to a certain amount. They still remain control, and we help professionalize it, streamline it, add governance, finance, and then build it up
exit together.
and exit together. Exactly.
Or not, or keep it for dividends. So that's our flexibility in our structure, that we're not a fund. So we don't have a mandate to exit.
Right.
And so if it's paying nice dividends, a lot of our investors want that. And if you're in a situation where you want to exit, that's where our secondary market comes in. So if you want to exit, you have the right to exit.
Right. Yeah. Yeah. No, it's interesting space. Okay. Well, thank you everyone for joining our 7th episode. Stay tuned for episode 8. It's going to be exciting. We'll release it in the next week.
And there's going to be a few more interesting guests, hopefully. We'll announce that shortly.
Yeah. No, we've got a few that definitely I know have committed to. So, but yeah, thank you very much and have a nice rest of your day. This recording will be available online in the next couple days. Thank you again.
Thanks, everyone. All right.